Bonds, like stocks and shares, are traded by investors. These include people like you and me, city institutions and other professional investors. Bond prices and bond yields have an inverse relationship, so if bond prices go down, the yield goes up and vice versa. The big factor that impacts bond prices is interest rates. This risk-free borrowing rate is set by each country's central bank. When rates go up, it means that investors can get a better deal from newly issued bonds, and therefore they sell old bonds to lock in a better rate from a new bond. When rates go down, this has the opposite effect. The old bonds that have higher interest rates become relatively more valuable. This is why bonds have fallen in value so far in 2022. With central banks increasing interest rates to get high inflation under control, investors sold bonds. If inflation cools and central banks slow the pace of interest rate rises, or even cut rates, bonds will go up in value, sending yields down. However, over the long term, rising interest rates can actually increase a bond's portfolio return, as the money from maturing bonds is reinvested in bonds with higher yields. Whereas when interest rates are falling, money from maturing bonds may need to be reinvested in new bonds that pay lower rates, potentially lowering longer-term returns. Another factor to watch is economic growth and the possibility that companies cannot pay back the interest on their bonds. While there is next to no chance that safe governments will stop paying interest, and very little chance that blue chip firms will default on their debt, even during a recession, the same is not true of the riskier end of the bond market, such as high yield or junk bonds. Inflation is also a consideration. Because bonds have a fixed income, the real value of that income is eroded more when inflation is high. This is bad news for bondholders, as unlike with stocks and shares, any benefits of inflation, such as high profits, is not felt by bond investors. You can find out more about investing in bonds on the II website.